Good day and welcome to the Veon Q2 2018 Results Conference. Today's conference is being recorded. At this time, I would like to turn the conference over to Mr. Richard James, Head of Investor Relations. Please go ahead, sir.
Good morning, ladies and gentlemen. Apologies for the slight delay, and welcome to Veon's second quarter results conference call. Today I'm pleased to be joined on the call by Ursula Burns, Veon's Executive Chairman, John Wesley, Veon's CFO, and Shell Johnson, Veon's COO. The presentation will start with a results overview and outline of our new strategic framework from Ursula, followed by Shell for Q2 country review, then John will run through the group results and reconfirm our 2018 outlook. At the end of the presentation, we'll open the line for the Q&A session. Before getting started, I'd like to remind you that we may make forward-looking statements during today's presentations, which will involve certain risks and uncertainties. These statements relate in part to the company's anticipated performance and guidance for 2018, future market developments and trends, operational network development and network investment, and the company's ability to realise its targets and strategic objectives, including current and future plans. Certain factors may cause actual results to differ materially from those in forward-looking statements, including risks detailed in the company's annual report on Form 20F and other recent public filings. The earnings release and earnings presentation, each of which include reconciliation non-IFRS financial measures today, can be downloaded from our website. I'd now like to go to Ursula for opening remarks. Ursula.
Thank you, Richard, and thank you all for taking the time to join us for this Q2 results call. Veon's performance year-to-date has been very strong. In the second quarter, we sustained the solid organic revenue and EBITDA growth that we achieved in the first quarter. This growth is driven by growing consumer demand for mobile data across the emerging markets that we serve and underscores our strategy of focusing our efforts in these markets. Veon is a highly cash-generative company. This funds the substantial investment that we are making to support our future growth and results in significant equity-free cash flow generation for our shareholders, amounting to more than $500 million in the first half of 2018. Based on this solid performance and our confidence in our business, I'm pleased to announce the increase of our ordinary interim dividend to 12 cents from $11 in the equivalent quarter last year. And we are reaffirming our guidance for the full year 2018. Turning now to our strategic framework, which will guide our balanced agenda of growth and discipline. Over the last several months, we completed a comprehensive review of our operating model and corporate HQ structure with the goal of delivering a simpler, lighter, and more efficient organization. To that end, on July 3rd, we set out the 4 key priorities. Many companies talk about emerging markets as a key driver of growth. The potential in mobile telecoms in emerging markets is truly outstanding. These are markets with young and fast-growing populations, and consumers in these markets are at the earlier stage in adopting the digital lifestyles that the developed markets now take for granted. Mobile phone penetration remains relatively low, and smartphone penetration lower still. For example, at only 25% in Pakistan. This all amounts to a significant opportunity for Veon as consumers adopt the services enabled by the rollout of 4G LTE, which is still at an early stage in most of our markets. The potential for ARPU growth is also attractive. You will have noticed from our announcements over the last few weeks that we are executing on all aspects of our strategy. The sale of our Italy joint venture to our partner CK Hutchinson is a great transaction for us. We will exit at an attractive multiple and will use the proceeds to strengthen our balance sheet by reducing leverage, supporting our dividend policy, and investing in growth opportunities. The sale of Italy is expected to close in the third quarter or early fourth quarter. It will, of course, sharpen our emerging markets focus and simplify our group structure, and the cash proceeds of $2.9 billion will have a significant effect on our financial position. More about this on the next slide. Our offer to GTH to acquire its businesses in Pakistan and Bangladesh will concentrate our ownership of these key emerging markets telecom assets and also simplify Veon's structure. We expect this transaction to complete in the fourth quarter of the current year, subject to both regulatory and shareholder approvals. It will have only a minor effect on our financial position. Again, more on this in a moment. As we announced on the 19th of July, we have also established a new lean operating model. This eliminates regional groups and the associated layer of management and costs, creating a flatter, more efficient structure that will give greater operational autonomy while maintaining robust compliance and internal controls. Our operating company CEOs now report directly to our Group Chief Operating Officer, Shell Johnson. HQ will focus on the delivery of logical shared services and governance functions. On digital, we are in the process of searching for a new Chief Commercial and Digital Officer to replace Christopher Schleffer, who will depart later this year. I want to be clear. Digital is and will continue to be a core part of our strategy. We will continue to invest in our technology platform to deploy services from our core to our customers, and will continue to evolve these services. Veon's digital investment started last year with a heavy focus on back-end technology investments, which is invisible to our customers, but nonetheless vital to the successful deployment of new digital services in the future. The investment in our platform is well advanced and will enable us to deepen our engagement with customers through various digital services in local markets. Our search for a new CEO is also progressing, and we will, of course, update you when we have something else to announce. Meanwhile, there is no leadership gap. The leadership team and I are operating with a keen eye on operational excellence, developing strategy, and assuring that we have a great team that is able to deliver. Now, turning to capital. We have a strong balance sheet, and it is the foundation of the long-term sustainability of our business, and it is therefore a top priority. At the end of the second quarter, our net leverage stood at 2.5 times EBITDA, above our target of 2 times. This is too high. On a pro forma basis, receipt of the proceeds from our Italy joint venture will take us to 1.7 times, and the completion of our offer for GTH would take us up only to 1.8 times, still comfortably below our 2.0 target, given that we already consolidate GTH. A strengthened financial position, of course, underpins our other strategic priorities, which are to support the payment of a progressive dividend based on the evolution of the company's equity-free cash flow. Reflecting the solid performance of the business and our confidence in our prospects, we are therefore increasing our interim dividend to 12 cents, which is progressing from 11 cents in the same quarter of last year. I'll now hand over to Shell for a review of country results. Shell?
Yeah, thank you, Ursula, and good morning to everyone. I'll start off with a little overview of all the major operating companies. And the good news here is that we see positive revenue EBITDA trends in the bigger countries here. That goes for Russia, Pakistan, Ukraine, and Uzbekistan. So giving us positive organic year-on-year revenue growth. With a similar pattern on EBITDA, impacted in Uzbekistan's case by taxes and termination rates. I'll get back to that. We have also seen yesterday the results from Wintrea. Wintrea's management has already commented on these numbers, so I'll largely focus on our operating companies. Starting off with Russia. We're happy to see that Beeline delivers good results in the second quarter. We are growing both in revenue and EBITDA, and that is despite the Euro integration costs. When we announced the first quarter, we warned that we would not potentially be able to absorb the full integration cost of Euroset. I'm happy to say that we've been able to do that through Q2. This is down to the market dynamics, where we see ARPUs growing overall in the market, a relatively benign competition picture, although we do see some heavy campaign activity, especially by Megaphone. Overall, this gives us a revenue increase of 6%, and coming largely from mobile service revenue growth. So this is digital service. This is the monetization of data coming through. 6.2% growth in data revenues is exactly what we would like to see, resulting in an ARPU of plus 5.6%. So the last year and a half, the industry has been able to come back to focusing on driving ARPU growth. The headline number on fixed lines is negative by 10%. We should then take into consideration that our wholesale services have been centralized. This amounts to around 600 million. If we adjust for this on a like-for-like basis, we do see a fixed line revenue decrease of 4.4%, and measures are in place to turn around the fixed in Russia and actively being developed. Overall, an EBITDA increase of 1.2% in nominal terms, despite the cost we're taking on to integrate Euroset into Beeline. Euroset integration is on track, and the plan to integrate 1,600 stores by August 2018 will be delivered upon. By the end of June, we saw already around 1,400 stores fully integrated and rebranded in Beeline. Looking at the overall distribution, we see a medium-term target of 5,500 stores that includes franchise stores. With the inclusion of these stores into the Beeline system, we are able also to turn around what used to be negative margins in devices to positive. So the bigger volume is helping us to drive a more profitable handset distribution. The forecast for the integration costs remain unchanged at around 3 billion. And of course, one of the consequences of going more in direction of monobrand distribution is we reduce our dependence on alternative retail. We believe this is positive for us. We believe it's positive for the industry. The alternative retail has been one of the reasons why there has been this washing machine effect in Russia with high churn, and we don't think that has given a lot of value neither to customers nor to the industry. When it comes to the rest of the year, we are cautiously optimistic. We had a very strong third quarter last year. We had a little bit softer fourth quarter. So we expect current trends to continue, but we do think that we should caution against expecting the same ARPU growth going forward. It will take a huge effort on the part of the industry to keep up those trends at the same pace, given the competitive pressures. Going to Pakistan, we are in the middle of a fast rollout of 4G, and Jazz is benefiting from that. We are leveraging our market leadership, and we see good revenue growth of almost 5%, and we see even stronger EBITDA dynamics at 16.8% year over year. We do see, of course, a lot of activity, political and currency markets, although we expect these things to stabilize somewhat after the elections are now finished. Also here, we are happy to see that the revenue growth is driven by mobile data. This is exactly what this industry needs to do and what we need to do. We need to be able to monetize data going into the 4G universe. We have increased our customer base by around 400,000 the last quarter. This shows that we have a good uptake of our 4G expansion. The EBITDA comes partly from the increased sales and from the data revenue growth, and also from OpEx synergies. We are now, of course, at the tail end of the integration of Varid into our Jazz operation. So overall, I would say strong margin expansion, now at 48.2%. and of course Pakistan becoming a very profitable market in EBITDA terms for Veon. CapEx is slightly down, but we are allocating the CapEx that is needed to fuel the 4G development of Pakistan, and overall a pretty strong story from Pakistan. In Algeria, I'd like to divide my comments a little bit into two areas. First of all, we see the trends are improving vis-à-vis other players in the industry. We see a management that handles the competitive situation really well. Unfortunately, the overall industry trend is still towards a downshifting in that market. We do see Mobilis operating with a quality level that you would not find in European markets overall. But Jesse is doing a good job at competing with Ooredoo and Mobilis in that market. Overall, despite doing well versus peers, revenues are still decreasing as the overall industry is under big pressure. We are now getting into also in Algeria a significant growth of data revenues, and of course we were going to fuel that going forward. The network investments we did in 2017 are paying off. We see 81% growth in data revenues, which is exactly what we would like to see. Still not being able to turn around the EBITDA trend, but we do see an increase in the customer base. So continued focus on driving the customer base and the data revenues is the remedy that we will prescribe for Algeria to return to stability going forward. Obviously a big country with a good potential for growth if the industry gets back to a bit more rational behavior. In Bangladesh, we have bought more spectrum. We have also rolled out 4G, which has given us a stronger position relative to peers, where we are driving that momentum quite actively. Overall, Bangladesh is, however, a challenging market. We do see a massive pressure in the competitive pressure in Bangladesh. So Banglalink going forward will continue with its strategy to acquire new customer based on the spectrum and the 4G resources that we have deployed, despite the negative overall trends in the market. The short-term results on customers is that we are growing 4.1% year over year. So the strategy in that sense works. We also see some sequential growth of service revenues on the back of data revenue growth. The overall picture is still that EBITDA is decreasing, and that is due to primarily to the decline in revenue and some increased OpEx due to the bigger network that we are now deploying. The network rollout is gaining pace. We've had a very good rollout in the first 6 months of the year. So we have invested into driving the customer acquisitions. But I have to warn that the regulatory environment is challenging in Bangladesh, and it's probably going to remain challenging going forward. So we are working towards stabilization in Bangladesh, but it is a tricky market. Turning over to Ukraine, very strong story, doing very well. We see good results during the quarter and still being a very strong market for Veon. We have strengthened our market position, also here due to a substantial growth of mobile data at 69%. We see double-digit growth. We see growing data usage, and we are about to deploy LTE 1800 based on the spectrum that we already possess in Ukraine. 8% growth year over year, high EBITDA margin in the mid-50s, which is the highest in the group, very positive numbers. We have also a very competent CEO in place running the Ukrainian operation, and I'm devoting a significant amount of time to the Ukrainian operation. Uzbekistan has embraced 4G, going out of the main cities into rural areas, we'll see a major pickup of 4G, leading to a revenue growth of around 10% year over year, and of course mobile data traffic doubling. This is now turning into a data revenue growth of 53%. The fundamentals of the company is pretty good. We have a couple of external factors that take down the EBITDA. I would then point out the tax changes that have come into force, and also the termination rates that have changed in the Uzbekistan market. We're generating cash in Uzbekistan, and we have also been able to repatriate money after the change in the currency policies of Uzbekistan. We will continue to repatriate cash for the remainder of 2018, which is a pretty good news. Let me then hand over to Trond for the financial results and guidance.
So going to the group numbers, we see in the second quarter a good revenue and EBITDA organic growth, leaving us at $2.3 billion in total revenue. That's a 3% organic growth and a negative 6.1% reported development year over year. On the currency element, Uzbekistan is accounting for 4%, approximately 4%, both in the revenue and EBITDA effect of that difference in between organic and reported revenue. It is the countries that Kjell has alluded to, Russia, Pakistan, Ukraine, and top line Uzbekistan, driving this organic growth. So the good countries are driving the good development. On the EBITDA, $857 million reported. It's 4.8% organic growth and a negative 8% reported. And compared to the difference of countries driving the top line, Uzbekistan, as a result of the tax issues, is not contributing on the positive note on the development year over year on the EBITDA. But other than that, a good progress organically on all countries. On CapEx, we're a bit higher than last year, $400 million. Due to the fact that we are pushing CapEx forward in the year. We are looking at the year-over-year or a CapEx to revenue ratio of around the 15% level, excluding the Yerovaya investment, as we have said before. Cash flow even to last year of around $200 million. And I'll get back to some details on all of these numbers. Going then to the waterfalls on revenue and EBITDA. On the revenue side, trend line is continuing, voice coming down and data MFS coming up. Looking at the strong data growth, as Kjell were alluding to, we have almost a 25% growth organically. That leaves us 11% growth reported on the growth. Coming then up to the almost $5 billion organic, and then the Forex and other changes coming down to the reported number. Of the Forex of 220, it's about 250 million in FX elements and a positive note on the Eurosat element that counters that leaves us at the 220. Going then to EBITDA, coming from 931 reported last year, we see revenue is driving this mostly, and you see the 4.8 organic growth coming up from the revenue development. But I think it's important also to note that organic cost is almost flat year over year, and that leaves a better cost intensity for the operations going forward. Forex and others is 102 on the Forex and approximately 15% on the Eurosat effect as Kjell were alluding to, that was taken in the second quarter. Going then to corporate costs. Corporate costs were low in second quarter of 54 million. The trend line is due to that we see personnel costs and historical costs coming down, but it was also release of a provision of around 15 million, and as a result, running costs in second quarter were about 70 million. And that gives us the clarity that we are en route to deliver on our cost decrease for the year of 20% down to the $350 million level. In addition to that, as Ursula were alluding to, by the changes and the decisions to change the headquarter and the structure of the operational structure going forward, we have also set a new mid-term target on the cost expectation for headquarter going forward, and that is to halve the 2017 level, which were 430 million, at the end of 2019 going into 2020. And that is to halve the 430, so basically around the $250 million level going into 2020. If we then go to the income statement, I'm not going to spend time on numbers down to EBITDA. I think we've covered that. On the finance expenses, no significant development going on there. On net forex, it declined due to the fact that in 2017 we have a repatriation of certain amounts of debt that led to a cost of 124 million, and as a result of that you don't see this year. Most of that were in Russia, and I'll come back to that on the tax line. Then on share of joint ventures, Italy has now become held for sale, and as a result Italy is not in this number. The only number you see here is on the second quarter of 2017, and that was the full impairment of the Euroset in 2017. That leaves us as a profit before tax of 171, and that's an increase of 278 million from last year. That leaves us with a tax line increasing on two elements of that. One is the effect of the repatriation last year. That was a taxable event that took the cost down also in Russia as a result of that. And the second thing is that as a result of improved profitability in Russia, Russian taxes is coming up, and that's the two main elements of the changes of increased tax cost from last year's second quarter. That leaves us at the profit for this quarter of 32. And you can see profit for the discontinued operation, which is Italy, is negative of 130, and that leaves a net loss for second quarter 2018 at 138. Going then to next page on cash flow, we have just wanted to show you the breakdown of the cash conversion in the group. And as you can see, the major contributors is Russia, Pakistan, Algeria, and Ukraine. You can also see the total effect of the group operating cash flow and slight improvement in working capital. I'll come back to that. And then interest and taxes and others having a payment of almost 300 million, leaving us an equity-free cash flow for this period of around 200 million. If we then go to the reconciliation table on the cash flow, I'd like to allude on changes in working capital. It is positive this year. It's two elements driving development in cash flow, of which both are planned and anticipated. One is the increase in some inventory as a result of Eurosat or going monobrand and having inventory that we expect to come down later this year. And then it's a few settlements that has come in that also were planned that has come into the second quarter. And as a result, even though we have inventory increases, we do see a positive development in the working capital. Going then to provisions, it really is severance being paid that is the majority of the negative outflow of this quarter. And then cash flow from operating activities is same level as last year on 600 million. 400 million coming in, going out to CapEx, and therefore equity free cash flow is in line with last year on $200 million. If we then go to the net debt development, I think we have covered all of the different elements in the waterfall. So I'm just going to say that we're going from almost 9 billion in net debt down to 8,645,000,000. That's a decline of $331 million in the quarter, and our gearing ratio last 12 months is then on 2.5. And as we said last quarter, we expected first quarter reporting to be at the highest level of net debt during the year, and we see that that is still progressing. Then the full year targets for 2018 this year is progressing well, particularly in Russia, Pakistan, and Ukraine. And I'm confirming our guidance for the year for flat to low single-digit organic growth in total revenue and EBITDA. We are also reaffirming our forecast for the equity-free cash flow before licenses, calculated on the 2018 rates to be around 1 billion. And as last quarter, I will confirm that that also includes the Yerovaya investments going in for this year. I'm also going to say that as a result of that, we are, of course, more pressured and then want to focus on the word around 1 billion. And with that, I'll hand over the final remarks to you, Ursula.
Thank you, Trond. In short, our businesses are performing in line with our expectations, and we're on track for 2018. Our strategic priorities are clear. We are moving aggressively to fulfill our vision as a lean, efficient, emerging markets-focused connectivity and internet services business. I would like to thank all of our colleagues for their support in realizing this vision. I'm pleased by what we have already managed to achieve, and I am confident that we will continue to deliver. We will look forward to updating you over the upcoming months and to realizing the financial benefits of our actions and our results in the 2019 financial year. Operator, can you please open the Q&A session now?
Thank you, Ursula. If you would like to ask a question at this time, please press the star or asterisk key, followed by the digit 1 on your telephone. Please ensure that the mute function on your telephone is switched off to allow your signal to reach our equipment. If you find that your question has already been answered, you may remove yourself from the queue by pressing star 2. Again, please press star 1 to ask a question. We will pause for a moment to allow everyone an opportunity to signal. We will now take our first question from Alexander Vengranovich from Sova Capital. Your line is open. Please go ahead.
Yes, hi. Thanks you for the opportunity to ask the question. So two questions, if I may. So on the transactions you announced basically before. So first, can you please update us on the progress with the approval of the GTH and Veon transactions? If there is anything new you can communicate with regards to the initial response from the regulators and how they see the transactions. And the second question is on the tower sale transaction in Pakistan. As far as I remember, it should have been closed in the second quarter this year. Can you please update us what's going on there and whether you still expect it to close this year? Thank you.
On the GTH transaction, it's progressing as it's supposed to in our view. We have given our view, which we think is a fair value of the assets of GTH for Pakistan and Bangladesh. It's now within the hands of the board of GTH, and they are evaluating, and they are also obliged to get a fairness opinion from one local bank that they're in the process of obtaining. When they then have reviewed the offer, they will then take a decision whether or not to proceed and go to a general assembly. That, to our knowledge, that decision has not taken yet, and they're still deliberating on the process. So it's very difficult for us to give you more insights since this decision will be taken by the independent directors in GTA. And as a result of that, we have been in dialogue with both GTH. We've been in dialogue with different minority shareholders, as well as Egyptian authorities. So we are including with all stakeholders, and we believe that we are progressing on our view from a Veon point of view on this to simplify the group structure in a good manner for stakeholders. So it's hard to say that timing of these events, but I guess the GTH board will update the market as we go along. When it comes to the Deodar transaction, yes, we were expecting that to close earlier this year. We are still missing the approval from Pakistani Telecom Authority, and as a result of that, both parties of the transaction are still working on closing of that transaction, and we're still working actively for that. But as a result of this has postponed over so long time, so it's hard to give you sort of a clear date since we have surpassed our date so far, but both parties are still working, and all issues in parties to close after an approval is given is already clear. So go for guidance.
Okay, thank you.
We will now take our next question from Stella Cridge of Barclays. Your line is open. Please go ahead.
Hi there. Good morning, and many thanks for the presentation as well. I have a couple of questions, please. The first one is actually on the timeline in Italy. So I know you've given a kind of broad indication, but I was just wondering what is the kind of specific events that we can look out for, and is there any specific date when a decision might be taken whether to approve the transaction or not? That would be the first question. And the second would be, so you'd highlighted when you gave out the news on the Italy stake sale, that you would aim to use some of the proceeds for debt reduction. So I was just wondering if you can give us an idea about how you're thinking about this. You know, would the priority be to reduce the cost of debt? Would it be to perhaps look at maybe the shorter part of the maturities? Just see how you're thinking about how you might apply those proceeds if the deal actually goes through. That'd be great. Thanks.
When it comes to the Italy transactions, we have previously said that we need 3 approvals from authorities to go ahead, which is condition precedent in the agreement, 2 from Italy and the EU. When it comes to Italy, we have got verification from NISA that approval is not needed, and as a result, we're left with one approval in Italy and one in the EU. All of this is filed, so we expect still that, so there's a timeline process for all of them. So we still expect to close in third quarter or early fourth quarter, but if timeline prevails for both of these applications, we should be able to actually close late third quarter. On the proceeds part, we are in the midst of that, and we are working our internal planning relative to finding the structure and the capital structure going forward. The euro exposure part is going to be reduced as a result of that. So we are working different angles relative to how to reduce the exposure or the currency exposure we have from US dollars relative to others, and whether we can use the euros as a counter in that. But we're also looking at potentials of increasing local currency, specifically ruble exposure, as a result of that. So we are working many angles in trying to think about our capital structure, but we just have to come back to you on the overall element, because we are in the midst of it.
Okay, all right, that's helpful. Many thanks.
Once again, if you would like to ask a question, please press *1. We'll take our next question from Orve Drue of HSBC. Your line is open. Please go ahead.
Yes, good morning. Thank you for taking my questions. I've been as well disconnected, so I apologize if I'm asking questions which have already been asked. The first question is regarding Russia. You mentioned some of your competitors' campaign, and during the call you said the output growth we've seen may potentially less high than what we've seen maybe in Q2. I just wanted to see, I mean, looking forward, for Russia, do you believe we still have more data monetization than what we've seen in the past still? And do you think ARPU nevertheless still has some good potentials, from growth coming from especially data monetizations? The second question is regarding Algeria. I understand that some of your subscribers numbers, now are kind of stabilizing, but there's still a lot of pressure on revenue and EBITDA with still quite significant decline. When do you believe you can start to stabilize as well the revenue and then the EBITDA for Algeria? If you can give an indication, that would be great. And finally, about your guidance on equity free cash flow. I believe this is based on your targeted FX for the full year. I was wondering how much buffer do you have if the US dollar continue to become stronger? That may put maybe a bit of pressure on the targeted equity free cash flow. Will you be, in your view, okay to increase debt to follow your increased dividend policy if currency is not moving the way you were expecting? Thank you.
Okay, this is Kjell. I will probably do 1 and 2, and Trond will take number 3. You asked about Russia and ARPU. I think the term we would like to use around that is that we are cautiously optimistic. There is room for the industry to work on continued data monetization, and through that drive a positive ARPU development. A lot of what we have seen now has been driven by customer value management becoming more important in Russia rather than chasing gross adds. That is a positive development, and all the three main players have been upping their competencies in that area. The next stage would of course be that step by step some of the headline numbers start reflecting the fact that data is still very cheap in Russia compared to very, very many other markets. So yes, I think there is a reason to be cautiously optimistic about the potential for driving ARPU in Russia. It will, of course, at the end of the day, depend on the competitive dynamics. The good news is that the industry over the last 12 to 18 months has understood and has acted in a way that shows that the understanding of the need to monetize data is there. When it comes to Algeria, yes, we do see an increase in the number of subs. That is due to a quite well coordinated effort where we improved our networks in 2017 substantially and had a concerted effort with the retail approach, especially in Algiers, where we had a very good approach to the market, which took us back into a much stronger position vis-a-vis competition. I think what will define whether the industry is able to drive revenue growth is whether we see that downshifting continue. 1,000 dinars is a very important price point in Algeria. If we see campaigning around the 500 price point, it's going to be hard to drive the revenues up for the industry as a whole. The moment we settle back into driving a 4G strategy with bundles and upselling on bundles, there is clearly room for improvement overall in Algeria.
When it comes to the target for the year of the 1 billion or around 1 billion, as we say, to be precise, we do say on the target rates that we have presented, the target rate is not too far off, and so the deviance is not that great. So in general, we do expect that that we will deliver on the nominal number, but of course we have to cater for significant currency changes going. We have disclosed very clearly in our report on page 30 the different target rates, average rates, and closing rates for that is used. So there should be no difficulty in understanding the sensitivity and the currency effect. We have worked very hard on the hedging on different currencies, specifically for the local currencies, specifically on capex in hard currency going into countries and exchanging that to local currency contracts, and as a result of that, there is more limited effect on the cash flow than on the top line relative to the currency effect on reporting, just to be very clear on that. When it comes to the dividend, our dividend policy remains the same. We do have a policy of progressive dividend supported by the underlying development in the equity free cash flow. As we see the world today, given the transactions that we have going and expect to close Italy, we see no reason for changing that policy or the certainty of continuing with that policy.
Thank you very much.
We will now take our next question from Slava Degratiev of Goldman Sachs. Your line is open. Please go ahead.
Yes, thanks for the presentation. Can you describe your commitment towards emerging markets? Do you see interest in M&A opportunities in the region beyond the countries of your current operations? Thank you.
When it comes to our expansion strategy, what we have been doing the last few years is really to look at potential in-market consolidation more than expanding our footprint. And we have been successful in that in many countries, and we have been focusing on that. So as of now, we do not have any more plans than we already have. And when it comes to country-by-country strategy, we will update you on our next capital market or our next overview, and there's no news in that regard.
Okay, thank you.
Our next question comes from Igor Goncharov of Gazprom Bank. Your line is open. Please go ahead.
Yes, thank you very much. I have a couple of follow-up questions on GTH deal and the free cash flow. On the free cash flow, you obviously reiterated your guidance, your forecast of $1 billion for the year before licenses. Could you maybe give us some indications of what does it mean in terms of free cash flow after licenses for the year? That's number one. And number two is just to clarify on the usage of the funds for on GTH transaction. If we assume that minorities of GTH do approve the sale of Bangladesh and Pakistan assets to Veon, is it correct to assume that you as a controlling shareholder of GTH will initiate a dividend, a special dividend to distribute the proceeds of the transaction between the shareholders of GTH? Thank you.
Well, when it comes to the GTH, I do think that I previously have explained the transactions and the overview. I didn't quite get what you wanted to elaborate about dividend.
Sorry, should I repeat the question, or I didn't understand the...
No, on the dividend flow and the money flow from the GTH and the upstreaming, I didn't quite get that.
Yeah, the question is, if we assume that minorities of GTH do receive do give the approval on the sale of Pakistan and Bangladesh, and they receive the funds from Veon, what would be the Veon strategy with regards to those funds as a majority shareholder of GTH? In particular, would Veon initiate dividend from GTH to other shareholders to distribute those funds?
Well, yeah, our view on that is assuming that the GTH board as well as minority approves our offer, we will, of course, go ahead by distributing the free funds of GTH to the shareholders. What is left in GTH after that fact, after the additional dividend coming out of GTH, is then the ownership of GESI. GESI is a dividend yielding company, and the remaining part of GTH will be without debt. So the remaining company of GTH will be a holding company getting upstream dividend from Algeria, which is sufficient both in substance and in cash flow to settle the potential tax claims from Egypt. And as a result of that, we do think that the transaction caters for both upstreaming of money to dividend, as dividend to shareholders as soon as possible, for a major chunk of the value of GTH, and retain the necessary value in GTH for cash settlements. While those discussions is ongoing, GTH will then be a dividend yielding company.
Okay, thank you very much. And with regards to the free cash flow to equity after the licenses, what amount do you anticipate for the year?
The licenses this year is really the one happened in the first quarter, which is Bangladesh and Ukraine. it's approximately a bit more than 400 million, 440 million. That is going to be paid for Bangladesh in Ukraine and has already been paid. So very little for the remaining part of the year. And the next one after these two is likely to be a renewal in Pakistan at the fall of 2019.
Okay, thank you very much for the answers.
Our next question comes from Sergey Levin from Raiffeisen Bank. Your line is open. Please go ahead.
Yeah, good morning, everyone. I have a bit of a forward-looking question. So assuming your transactions are closed, after Italy and GTH, you are down to 1.8 times net debt to EBITDA, and tower transaction in Pakistan takes it even lower. So do you have a longer-term plan of what you're going to do at quite below your target leverage ratio? So you said you do not really plan to do any external M&A. So maybe is there a potential for additional cash distribution or any other thoughts on that? Maybe you'll be comfortable with living at a lower debt level. So what do you think on this issue?
Well, assuming that we are closing all this going forward, you're right in your equations. So we're going down to 1.8 after GTH, and considering Deodar, we're going to take a slight notch lower than that. Having said that, I do think that these transactions, in the first instance, if we consider the discussion that we have been having with the shareholders of leverage until now, I think that we are going to close these transactions. We are going to look at the capitalization and the structure of the capitalization of the group. As of now, either the board or the management have revisited the dividend policy or the leverage policy as a fact of not having a European exposure in the operations anymore. So as of now, our target is still the two, and the dividend policy is still in place. And I do not expect any significant changes to those numbers in the immediate future. But of course, if currency involvements, with other involvements and changes occurring, I'm not saying it's not going to happen, but as of now, we are still comfortable with 2.0 around the 2 gearing level, and the dividend policies still stay in place.
All right, thank you.
Our next question comes from Alexander Vengranovich of Sova Capital. Your line is open. Please go ahead.
Yes, thanks for the opportunity to ask follow-ups. So 2 questions. First one, more like strategic one. So once you hire the new permanent group CEO, what do you think in your new management strategy and the paradigm of the business? How do you think the role of the new group CEO might change? Do you expect any subsequent changes, significant subsequent changes to the company's strategy following that, or should we assume that your current strategy should not be affected by the replacement of the permanent group CEO? And the second question is a follow-up on equity free cash flow. Sorry for bothering you again. Can you disclose the size of the equity free cash flow in constant currency terms in first half 18? Thank you.
Let me take the CEO and strategy question, if I may. The move that we're making in the company, the strategic direction that we have set, both in portfolio as well as organization structure, are areas that I don't expect that there will be any changes to when we appoint the permanent CEO. These are logical moves that have been thoroughly reviewed and vetted with our board and obviously with the management team. So I expect the fundamental strategy to remain the same. The skill set or type of CEO, we have a very good set of operating executives in the field. Shell Johnson is an outstanding COO. We've made him a permanent COO there. So I think that we have an operating model that will allow the new CEO to focus a little bit more on growing the business in new areas, in new ways, adding different or additional revenue streams to our businesses around the world. But the core business of us being a telecom company, strong and leading from a tech perspective, will remain the same, and the new CEO will, like I said, add some skills around the edges. Strategy the same, direction the same, strong operating executives, and focus on emerging markets. And Trond, why don't you take the second part of the question?
I'll do that. When it comes to the organic element of the free cash flow, we don't disclose that as such, and the reason for that is that we don't disclose the working capital changes, interest payments, and so forth in the local currency. So we aggregate that into one. So probably the best way you can get a proxy on that is really just to use the proxy on EBITDA minus capex. But working capital, interest, and so forth, we are not disclosing. So I'm sorry, I cannot give you that number.
Okay, thank you. That was helpful.
We will now take our final question from Mr. Simon Cook from Inside Investment. Your line is open. Please go ahead, sir.
Hi, thanks. I just wanted to follow up on the use of proceeds from Italy and obviously net from the GTH transaction. So if I'm thinking right, you're getting around $2.9 billion from Italy, and you're going to spend net around 400 buying out Bangladesh and Pakistan. I think you flagged optimizing the balance sheet as one of your considerations with the remainder of the proceeds. Could you just talk through exactly what you're trying to achieve there and the kind of buckets of debt that you might focus on if you are, I guess, doing liability management or something else? Thanks.
I have to revert to my previous question. That was sort of the same element. We are going into a review, of course, of the capital structure as a result of getting these proceeds in, and also that we are then taking out our exposure to euro on operational in the operational exposure. So we're in the midst of that, and we are elaborating on opportunities of how to optimize the capital structure going forward. But we have to get back to you on how we want to optimize it.
Okay, thank you.
This concludes today's question and answer session. I'd now like to turn the conference back over to you for any additional or closing remarks.
Ursula?
Yes, so thank all of you for joining and for asking your questions. And we will continue to execute on the strategy that we've spoken about and on an aggressive plan to continue to transform the company and to participate and serve customers in the emerging markets areas. We'll see you at the next, or at least hear you at the next earnings call. So thank you for joining.
That will conclude today's conference call. Thank you for your participation. Ladies and gentlemen, you may now disconnect.